Inflation is that silent enemy that destroys purchasing power without you noticing. Prices rise, wages stay the same, and what yesterday filled a shopping cart today barely covers a few bags. In countries like Argentina, Venezuela, or Turkey, inflation is not just an economic concept, it's a reality that strikes millions of families. Every month, every week, even every day, money is worth less. In the middle of this chaos, one question arises: can cryptocurrencies be a way out of inflation? Can they become a safe haven, an alternative to money that melts away in our hands? Inflation is not felt in economists' charts, it's felt in the streets. In Argentina, a salary in pesos that seemed decent at the start of the month barely covers basic needs 30 days later. In Venezuela, families have lived with prices doubling in just weeks. In Turkey, young people and professionals have seen their currency lose more than half its value in just a few years. The results are devastating. Saving in local currency stops making sense. People rush to supermarkets before prices rise again. Families desperately look for safe havens: dollars, goods, anything that doesn't lose value so quickly. Inflation erodes not only people's wallets, but also their trust in institutions and the future. In 2008, the financial world collapsed. Banks had speculated recklessly. Governments printed money, and ordinary people paid the price. In the middle of that crisis, an anonymous document appeared online: the Bitcoin white paper, signed by Satoshi Nakamoto. Its promise was simple yet revolutionary: a decentralized electronic cash system without banks, governments, or intermediaries. Bitcoin was born as a response to inflation and distrust. An asset with a limited supply, 21 million coins and no more, designed to be a hedge against the money that central banks print uncontrollably. That's why many call it digital gold, an asset that cannot be counterfeited, cannot be devalued at will, and that, in theory, protects against long-term inflation. But if Bitcoin is a long-term hedge, what about daily life? This is where stablecoins come in. A stablecoin is a cryptocurrency whose value is tied to a stable asset, usually the US dollar. Examples: USDT, Tether, USDC, Circle, DAI, MakerDAO. In countries facing inflation, stablecoins have become an immediate alternative. They allow people to save in digital dollars without needing bank accounts. They can be transferred in seconds with minimal fees. They are often more accessible than physical dollars, which are restricted by governments. For millions of people, stablecoins are the real bridge between cryptocurrencies and everyday life. Statistics are clear, but stories matter even more. In Argentina, thousands of people buy USDT every month to protect their savings from peso devaluation. Merchants accept crypto payments because they know tomorrow cash will be worth less. In Venezuela, where hyperinflation hit unimaginable levels, Bitcoin and stablecoins became real payment alternatives. Restaurants, shops, and freelancers use crypto to survive instability. In Turkey, young professionals prefer moving their salaries to USDT rather than keeping them in liras, which lose value constantly. The digital generation understands that while crypto has risks, it is often safer than watching their money vanish through inflation. These cases show that, far from speculation, cryptocurrencies already fulfill a real and vital function in struggling economies. But it would be naive to think cryptocurrencies are a perfect solution. The first risk is volatility. Bitcoin and other cryptos can rise 20% in a day, but also drop 30% in hours. For those seeking stability, that's a huge problem. The second risk is scams and fraud, exchanges that disappear overnight, fake projects, promises of guaranteed profits that turn out to be Ponzi schemes. The third is technological inequality. Not everyone has stable internet, smartphones, or the knowledge to manage digital wallets safely. And finally, the regulatory risk. Governments that limit, restrict, or crack down on crypto use, leaving users in legal gray areas. The future of cryptocurrencies against inflation is uncertain, but promising. On one hand, adoption grows every year in countries hardest hit by devaluation. On the other, governments are pushing to regulate or control the movement. The most likely scenario is coexistence. Cryptocurrencies and stablecoins as a hedge and digital tool. Fiat currencies as official means of payment. and perhaps a new generation of central bank digital currencies, CBDCs, that combine the best of both worlds with less freedom. The question is not whether crypto can help against inflation, but how long it will take to become the preferred option for millions.